Welcome back to the Daily Crypto Deep Dive. Today we're going to talk about one of the strangest financial realities of our time, one that barely gets discussed in mainstream media. The United States government, the same institution that once called Bitcoin a tool for criminals, is now one of the largest holders of Bitcoin on the planet. Not by design, but by circumstance. If you're new here, hit follow and drop a 5-star rating. It keeps episodes like this reaching the people who actually care about truth, not noise. Through years of criminal seizures, forfeitures, and tax recoveries, Washington has quietly built a digital war chest. These coins were never mined, never bought on an exchange, never voted for in Congress. They were confiscated, yet they sit on the public ledger like any other wallet, traceable, immovable, and increasingly valuable. Right now, blockchain analysts estimate the US controls more than 210,000 Bitcoin, worth roughly $23 billion at current prices. That's a national asset larger than the foreign reserves of some countries. And it keeps growing, block by block, seizure by seizure. But here's the twist. There is no single US Bitcoin fund. These coins are scattered across addresses controlled by agencies like the Department of Justice, the US Marshals Service, and the Internal Revenue Service's Criminal Division. Each branch has its own remit, its own policies, and its own bureaucracy. And yet, when you zoom out, they all form one giant on-chain footprint, an accidental sovereign Bitcoin reserve. The story starts back in 2013 with the fall of the Silk Road. When FBI agents arrested Ross Ulbricht, they didn't just seize a few servers, they captured about 144,000 Bitcoin tied to the marketplace's wallets. At the time, Bitcoin was trading near $130, a headline curiosity, not a national treasure. The Department of Justice auctioned most of those coins off the following year, selling them in tranches to a handful of early whales, including venture capitalist Tim Draper. He paid roughly $18 million for what is now worth billions. The government pocketed the dollars, not the crypto, thinking it was cleaning up after a digital drug bust. That auction set a precedent. Every time federal agents seized Bitcoin thereafter, from darknet sites, ransomware operations, or tax evaders, the standard procedure was to liquidate through the US Marshals. By 2018, they'd sold over 200,000 BTC in total, raising around $1.2 billion. But here's where the story starts to shift. As Bitcoin's price soared past $20,000 and later $60,000, the Treasury realized that holding these assets, even temporarily, carried real balance sheet implications. What had once been digital evidence now looked like strategic inventory. The idea of how to store and dispose of it became a policy question, one that would resurface every time another major seizure occurred. Fast forward to 2020 and beyond. The IRS, Secret Service, and DOJ all began building new custodial protocols. Instead of hot wallets and ad hoc exchanges, seized coins were to be stored in cold wallets managed under multi-agency contracts. Private companies like Anchorage Digital and BitGo were brought in as secure custodians. The language shifted from destroy the proceeds of crime to manage digital assets responsibly. That bureaucratic pivot matters because it turned temporary holdings into something resembling a treasury function. Each time a high-profile case closed, whether the Bitfinex hack recovery, the Colonial Pipeline ransomware payout, or Silk Road follow-ups, more Bitcoin flowed into federal custody. By 2023, blockchain analysts started noticing distinct wallet patterns. Big, neatly labeled clusters that matched seizure announcements. Arkham Intelligence, Glassnode, and Elliptic all tracked them. Collectively, they mapped out one of the largest single-entity Bitcoin footprints in existence, second only to Grayscale and the cold wallets of Binance. What makes it fascinating isn't just the size, but the intent, or the lack of it. Unlike El Salvador, which openly buys Bitcoin for reserves, or China, which mines and hoards through state-linked entities, the US acquired its stash by accident. Yet, whether by inertia or design, it now sits on tens of billions of dollars in programmable money. And the blockchain can see every Satoshi. That transparency creates tension. Whenever the government moves coins between wallets, traders panic. We saw it again this week when 667 BTC, roughly $74 million, left a DOJ-linked address. Prices dipped instantly, Twitter lit up, and analysts scrambled to determine whether an auction was imminent. In reality, it was likely a custody reshuffle. But perception matters more than intent. The irony is incredible. A government that once denounced Bitcoin volatility now influences it. One Arkham analyst joked, "When the feds move coins, the market holds its breath." Let's pause and put that in context. The same US institutions that issue dollars, regulate banks, and police financial markets are now de facto participants in the Bitcoin economy. They hold private keys, manage wallets, and periodically execute on-chain transfers large enough to move global sentiment. And the story's just beginning. Because the question isn't how much Bitcoin they have, it's what they intend to do with it. So far, official policy still points toward liquidation. The Marshals Service sells assets periodically, often through tightly controlled auctions or exchange contracts. But as the totals grow, liquidation becomes harder to justify politically. Do you really sell a strategic digital reserve that keeps appreciating? Do you hand billions of dollars worth of censorship-resistant money back to the market in the middle of an inflationary decade? Some insiders quietly argue no. They believe the US should treat seized Bitcoin not as evidence, but as a sovereign hedge, a digital counterpart to gold reserves. One former Treasury consultant told Bloomberg, "If the US holds gold, strategic oil, and SDRs, why not Bitcoin? You can't ban an innovation and simultaneously pretend it doesn't exist on your balance sheet." That's where this story turns geopolitical. Because whether Washington likes it or not, Bitcoin holdings are now part of the global power equation. China mines it, Russia sanctions it, El Salvador brands itself with it, and the United States, simply by virtue of enforcement, accumulates it. In 2024, when the DOJ announced the recovery of 94,000 BTC from the 2016 Bitfinex hack, valued at $3.6 billion at the time, it became one of the largest single seizures in history. The sheer size of that recovery reignited the debate inside government circles. Should those assets be auctioned or held as strategic digital collateral? The official answer was auction. The unofficial conversation went deeper. According to Freedom of Information filings, multiple agencies were studying how to value and report digital assets on federal balance sheets. In other words, how to treat Bitcoin like a commodity reserve. That kind of research doesn't happen by accident. The irony is that Bitcoin, designed to exist beyond governments, is now being absorbed into the machinery of the most powerful one on Earth. When the US government seizes Bitcoin, those coins don't go straight to auction. They first pass through a long bureaucratic chain. And the process tells you more about how the state views crypto than any speech or policy paper ever could. After a seizure, agencies must secure, document, and value the assets. They call this evidence retention, but it looks a lot like portfolio management. Coins are transferred to custody providers under federal contract. Companies like Anchorage Digital, BitGo, or Coinbase Custody, which are paid to store and secure the private keys in cold wallets on behalf of the government. Every transaction is documented, every address is monitored, and because these wallets sit on public blockchains, analysts can trace nearly every movement in real time. Once court proceedings end and ownership is legally forfeited, the coins move again. This time to the US Marshals Service, which acts as the government's disposal arm. That's where the real action starts. The Marshals' mission is simple on paper: sell the seized property, return proceeds to victims or the Treasury. In practice, it's a complex dance of security, secrecy, and logistics. Auctions are rarely announced far in advance. Bidders must pre-register, submit deposits, and prove compliance. The process resembles a private placement more than an eBay sale. When they first began liquidating Bitcoin, the Marshals used sealed bid auctions. Participants sent wire deposits, received wallet addresses, and submitted blind offers. The highest bidders would get tranches of Bitcoin transferred directly after payment confirmation. The most famous of these auctions was in 2014, when Tim Draper won nearly 30,000 BTC from the Silk Road Hall. At the time, each coin was worth about $600. His purchase, ridiculed then, turned into one of the best investments in modern history. Draper paid roughly $18 million for coins now worth billions. But it isn't just venture capitalists who profit. Every liquidation floods liquidity back into the market at scale. When the marshals sell, those coins often end up in the hands of funds, custodians, or ETFs, re-entering circulation through regulated channels. In a strange feedback loop, Bitcoin seized from criminals often ends up as collateral for institutions. Still, each auction carries risk. The government can't move coins too quickly without spooking traders or telegraphing large dumps. Over the years, officials have learned to fragment sales, smaller tranches, more frequency, less spectacle. The modern approach is more discreet. Instead of public auctions, agencies now sometimes transfer seized coins to exchanges under controlled contracts for gradual sale. It's quieter, but it still leaves digital fingerprints. You can watch those transactions unfold on-chain like slow drips from an invisible hand. Traders have grown obsessed with this pattern. On-chain analytics firms like Arkham Intelligence and Glassnode maintain alert systems for US government wallets. Whenever coins move, speculation ignites. Is it an auction? A custody swap? A sell signal? That speculation itself now moves prices. Proof that the government, without meaning to, has become a market participant whose actions carry monetary weight. Here's the paradox. Every sale intended to show regulatory dominance ends up validating Bitcoin's liquidity and permanence. You can't confiscate, hold, and auction something that doesn't work. Each time Washington liquidates a batch, it simultaneously confirms Bitcoin's status as an asset class. It's enforcement and endorsement in the same breath. Inside Treasury and Justice circles, not everyone agrees with the current policy. Some career officials argue the government should continue selling, warning that hoarding digital assets could invite accusations of manipulation or conflict of interest. Others, often younger policymakers, quietly push the opposite view. They see strategic value in retaining a small reserve, especially as Bitcoin becomes woven into global finance. One leaked internal memo from 2023 discussed whether the US should maintain a standing digital asset balance for operational flexibility. The language was dry, bureaucratic, but it hinted at a deeper question. What if this technology becomes too important not to hold? Look at how other nations behave. China controls massive amounts of Bitcoin indirectly through confiscated mining operations and exchange crackdowns, though it rarely admits it. Russia now uses crypto rails to bypass sanctions and settle cross-border trade with sympathetic states. El Salvador openly holds Bitcoin as national reserve. Even Ukraine has raised millions in Bitcoin and Ethereum donations since the war began, effectively treating crypto as emergency funding infrastructure. Against that backdrop, the United States stands out as the accidental whale, unwilling to claim ownership, yet unable to deny it. Some analysts call it shadow adoption. The state refuses to invest officially, but its behavior mirrors that of an institutional holder, securing assets, tracking flows, managing counterparties, and occasionally realizing gains. If you zoom out, this shadow policy may already be serving a quiet purpose. The US dollar remains the global reserve, but its credibility depends on technological agility. Holding, even temporarily, large volumes of digital assets gives policymakers first-hand experience with custody, chain analysis, and decentralized liquidity. It's an education by participation. The same agencies that once fought crypto crime are now effectively running crypto experiments at scale. They test secure storage, key management, and traceability. All the skills needed if the US ever issues a digital dollar or tokenized bonds. It's a test lab wearing a badge. Meanwhile, the market treats each government move like a signal. When coins stay dormant, traders interpret it as confidence. When they move, fear follows. That psychological feedback loop gives Washington subtle influence, not because it's trying to manipulate prices, but because transparency makes every decision visible. Consider what that means strategically. Unlike gold, which hides in vaults, Bitcoin broadcasts its existence. Any nation can audit another's holdings in real time. That creates a new dimension of economic signaling, a transparent balance sheet diplomacy. Imagine a future where nations subtly accumulate or move Bitcoin as geopolitical messaging. In that world, America already holds an advantage. It controls a vast, publicly verifiable stack and the expertise to manage it. Even if every coin were sold tomorrow, the institutional know-how remains. And that might be the real long game, learning the mechanics of digital wealth before others do. In one sense, America's Bitcoin story is a parable about power. The same technology designed to remove intermediaries has forced the ultimate intermediary, the state, to adapt. The code didn't eliminate government, it educated it, and yet the contradictions persist. Congress still debates stablecoin bills. The SEC still battles exchanges. The White House still issues cautious statements about speculative risk. Meanwhile, federal wallets hold tens of billions in the very asset they warn about. It's as if two versions of America coexist: the ideological America that distrusts Bitcoin, and the operational America that quietly masters it. If history is any guide, the operational one always wins. Every disruptive technology follows the same arc: resistance, regulation, integration. The internet did. Artificial intelligence will. And Bitcoin, for all its volatility, is tracing the same curve. So where does that leave us? Perhaps the most powerful nation on Earth is unknowingly building the infrastructure it once feared. Custody systems, compliance frameworks, and market literacy. Tools that will one day underpin its own digital future. Because when you strip away ideology, Bitcoin is just code, and code is leverage. As one former NSA cryptographer told Wired earlier this year, the moment you hold private keys, you're part of the experiment. And the United States, keys in hand, is deeply in it. That's why traders shouldn't just track prices, they should track behavior. Watch the cadence of those wallet movements, the contracting custodians, the language and Justice Department statements. Those are the breadcrumbs of policy evolution. If the past decade was about enforcement, the next may be about strategy. At some point, the world's largest enforcer becomes the world's most informed participant. And that's the quiet truth behind the US Bitcoin Reserve. It isn't an accident anymore. It's a mirror, showing how deeply blockchain has embedded itself into the machinery of modern governance. Thank you so much for listening, and as always, we'll see you at the top.